Your call was right. The stock went up. The option expired worthless. Here's why. You think a stock is going up. You buy a call option. The stock goes up. The call still expires worthless. That happens to most new options traders, and it's because direction alone is not a strategy. A real option strategy has 4 inputs: direction, volatility, capital, approval tier. Get all 4 right, and the structure almost picks itself. Get any one wrong, and even a correct directional call loses money. Before any of that, the toolkit. Every option strategy in existence, every condor, butterfly, calendar, diagonal, is built from just 4 trades. Long call, long put, short call, short put. That's it. Long means you paid premium for the right to do something. Short means you collected premium for the obligation to do something. Buyers bet on movement, sellers bet on stillness. That's the whole game in one sentence. Every so-called complex strategy is just 2 or 3 of those 4 legs stacked together, with a different risk profile bolted on. Roughly 11 billion US options contracts traded in 2024. Every single one was made of these 4. See the building blocks first. The rest is architecture. 2 of those 4 are where every retail trader starts. Long call. Bullish, you pay premium, max loss is the premium. Long put. Bearish, same logic flipped. Both feel cheap. Both have the same hidden enemy: theta, time decay. Every day the stock doesn't move enough in your direction, the option bleeds value. That's why a long call can lose 100%, even when you were right on direction. You weren't right on size or on speed. Around 70 to 80% of long options expire worthless. That's not a glitch. That's the design. Now flip to the other side. Cash secured put. You sell a put on a stock you'd actually want to own at a lower price, and you hold the strike times 100 in cash as collateral. If the stock holds above the strike, you keep the premium. If it drops below, you buy the shares at an effective price below the strike, because the premium you collected reduces your call basis. Covered call. You own 100 shares, you sell a call against them at a strike above the current price. You collect premium on top of any dividends. Both flip theta around. Time decay now works for you. That's the real mental shift. Stop thinking buy or sell direction. Start thinking buy or sell time. Once theta is on your side, the next step is structure around it. Vertical spreads. You buy one option and sell another at a different strike, same expiration. A bull call spread costs less than an outright long call, because the short leg you sold partly funds the long leg you bought. The trade-off? You cap your upside in exchange for a lower entry cost and a higher probability of profit. There's a debit version and a credit version of every spread. Debit spreads. You pay to enter, you want the stock to move your way. Credit spreads. You collect to enter, you want the stock to stay put. Here's the catch most retail traders miss. Credit spreads have asymmetric risk. You might collect 30 cents to risk 70. So you have to be right far more often than wrong just to break even. That's not a flaw. It's the price of putting theta on your side. Verticals are 2 legs. The next tier stacks 4. Iron-condor. You sell an out-of-the-money call spread and an out-of-the-money put spread on the same expiration. You collect premium from both sides. You profit if the stock stays inside both short strikes by expiration. The classic income trade for a market going nowhere. Works best when implied volatility is elevated, because then the premium you're collecting is actually worth the risk. Calendar spread. You sell a short-dated option and buy a longer-dated one at the same strike. You profit from the short option decaying faster than the long one. Calendars also benefit from rising IV after entry. Straddle and strangle. You buy a call and a put. You profit if the stock moves significantly, either direction. Use before binary events like earnings when you expect movement but can't call which way. Here's the trap. Straddles are long volatility trades. If implied volatility is already high going into the event, the typical earnings setup, the IV crush after the event compresses option prices and can wipe out the position even if the stock moves. None of these are direction trades. They're volatility trades. An iron-condor bets the market overestimated future movement. A straddle bets the market underestimated it. Without a volatility view, you cannot use these strategies. Full stop. Which brings us to the missing link, the Greeks in IV rank. Delta is direction. Gamma is how delta changes. Theta is time decay. Vega is sensitivity to implied volatility. Every strategy has a Greek signature. Iron-condor, short delta near the strikes, positive theta, short vega. Long straddle, flat delta, very negative theta, long vega. You don't need to calculate them, you need to recognize them. Now IV rank. This is where the professional desks separate from the retail crowd. IV rank tells you where current implied volatility sits between its 52-week low and high. Below 30, premium is cheap, you buy it. Long calls, long puts, debit spreads. Above 60, premium is expensive, you sell it. Credit spreads, iron condors, short premium. Between 30 and 60, neutral, structure to your direction view. That's the filter. Pick the strategy that fits the IV regime, not your mood. Even with the framework, you'll still hit the same traps everyone hits. 5 of them. 1. Buying far out of the money calls before earnings. You're paying maximum premium right before IV crush wipes it out. 2. Ignoring liquidity. A 10-cent slippage on entry plus another 10 on exit eats your edge before you start. 3. Not closing winning credit spreads. The last 20% of profit takes half the time. Take it at 50 to 80% and redeploy. 4. Selling premium when IV rank is low. The premium is too small to compensate for the binary event risk. 5. The big one. Confusing direction with strategy. I'm bullish is not a strategy, it's an input. And before any of this is real, your broker has to let you trade it. US brokers tier options access from 1 to 4. Level 1, covered calls and protective puts, anything backed by underlying shares. Level 2, long calls and long puts. Level 3, spreads, verticals, calendars, butterflies, condors. Level 4, naked short options, the unlimited risk tier with full margin requirement. You can have the perfect framework and still get blocked at the platform because you didn't qualify. Apply for Level 3 early. For platforms, the names worth knowing in the US are Interactive Brokers, Tasty Trade, Schwab, and Fidelity. In Europe, Saxo, IG, DeGiro, and IBKR cover most use cases. Sizing matters too. Disciplined traders cap any single position at 1 to 5% of account equity and close credit spreads at 50% of max profit instead of holding for the last few cents. Discipline is the structure around the structure. Back to the question we started with. You bought a call. The stock went up. The call still expired worthless. Now you know why. You had direction. You didn't have a volatility view. You didn't have time on your side. And you didn't have an IV regime that made buying premium the right move. The framework is 4 inputs: direction, volatility, capital, approval tier. Get all 4 right and the structure almost picks itself. Master long calls and long puts first, then verticals. Everything above that is architecture built on those 2 foundations. The strategies don't make you a trader, the framework does.
Now you have the framework: direction, volatility, capital, approval tier. Check the description for the complete breakdown.